From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. While the global economy has expanded at a moderate pace this year, ongoing U.S. policy shifts are causing havoc in the equity markets, which are really having a ripple effect all across the world. So could a recession be in the cards? Today we're going to break down key economic indicators to help shed some light on this topic. In light of heightened trade policy uncertainty, J.P. Morgan Research announced at the beginning of April that they raised the probability of a global recession taking hold in 2025 all the way to 60%, up from 30% at the start of the year. So let's take a look at the economic indicators that are raising red flags and could signal trouble ahead, starting with the GDP. The Atlantic Federal Reserve's forecasting tool predicts a minus 2.8% contraction in the first quarter of 2025. If it's accurate, this would make the first GDP decline since early 2022. Next, the consumer sentiment is slipping. The Conference Board's expectation index dropped to 72.9 in February, its first dip below 80 in 8 months. This is reflecting concerns over recent economic policies, including tariffs. And finally, consumer spending is down. Data from the Bureau of Economic Analysts shows a 0.2% decline from December to January, the first monthly drop in nearly 2 years. So does this mean a recession is on its way? No one can predict that, and while these indicators can give a small snapshot of the economy, they don't give the full picture. Plus, economic news doesn't always have to be positive for stocks to rise or to take advantage of opportunities in the markets. What I encourage people to do is work with a fiduciary team that takes a data-driven approach with proven processes to make decisions and customize the portfolios specifically designed for your goals and objectives. So with our team of analysts and all the available tools in the industry at our fingertips, we can build portfolios that have protection already in them for volatile times like this. We can also use income-producing strategies that continue to provide that monthly income you want in retirement regardless of market conditions. The difference between us and many other advisors is that we are proactive, not reactive, and it can really help smooth out some of the volatility to try and help provide you with a more comfortable retirement. We think that the ride will continue to be bumpy for the next several months, but there's some good news. Over the last 100 years, 10% corrections happen 60% of the time, and 15% corrections happen 40% of the time. So in other words, they're not as infrequent as you may think. But there is some good news. In years with a 10 to 20% correction, the full year returns on average hit 15% by the end of the year. What our analysts are helping our clients with is now being proactive with tax loss harvesting, trading up to higher quality investments where appropriate, and continuing to be proactive to take advantage of every opportunity we can for our clients. So if your advisors are not doing the same thing, you should find out why. So having a proactive, knowledgeable team and an advisor who is a fiduciary on your side can make all the difference in navigating market uncertainty. So if you're looking for guidance tailored to your financial goals, call us today. We're here to help. Stay tuned for Fox News Sunday.